It is now my pleasure to introduce our further participants, and also a pleasure to welcome Klaus Regling. He's Managing Director of the European Stability Mechanism and CEO of the European Financial Stability Facility. He has held high-level posts at the IMF in Washington and Jakarta, and at the German Ministry of Finance, and also served as Director General for Economic and Financial Affairs of the European Commission. And Klaus Regling, please.
Yes, hello. Let me start with how Carmen also began, and I think it's very important for economists to be humble and show humility. These are exceptional, difficult times to analyze correctly. We are not very good in identifying turning points. That is clearly the experience of the last decades, and I think it's no different now. I assume we will dig more into inflation and debt issues later. Indeed. Therefore, let me now talk about 2 points that may not come up so much later. One is also listening this morning to the first panel. There's a lot of talk about inflation risks for understandable reasons. And I think there might not be enough focus on financial stability risks. They were mentioned occasionally this morning by Jean Lemaire, for instance, but the main focus of the public debate and the debate this morning was on inflation, and I wonder whether that's really the right focus, or at least we should not forget the other risks. Mm-hmm. There are the financial stability reports, most recently early this week from the ECB, that talks about the overvaluation of financial assets. But this is not really the focus of the monetary policy debate that I see happening, and I think we may have to refocus a bit. The other point I want to get out of the way is our panel is about macro policies, and when we look at fiscal policies and debt, no doubt we will all struggle to find the right balance between supporting growth but maintaining debt sustainability. But when we look at growth, and that's the point I want to make, growth comes not only from debt. Building up debt helps in the short run, but I think in the longer run, of course, there are structural reforms. Of course, there's a question of the right growth-friendly revenue structure of budgets, and the question of the quality of budgetary expenditures. So it's not only debt, one has to look at these other issues, which is not the focus of our panel here today, but I wanted to say it before we get deeper into debt and inflation.
Thank you very much. Klaus Regling, you talked in your opening response about financial stability. What are the main financial stability risks around inflation? What are the concrete dangers that you see?
Well, on inflation, if I may start with that, I would agree with what has been said, but the real interesting question is what happens, let's say 12 months from now, because I think it's helpful to differentiate between short-term, medium-term, and long-term. And on the short term, the next 12 months or so on inflation, I more or less would agree with what Christine Lagarde said this morning. The base effects are just very strong. So I would agree that inflation will come down. But what happens then after that in the medium term? Because Europe is different from the US. Charlie and Marcus talked about that. We don't see second round effects yet in Europe. But the longer the short term lasts, the easier this can happen also in Europe. We have a few countries in Europe where we have indexation. Not many, but some, and there's then second round effects are in a way automatic. There's also the problem that we should not forget as economists, that is, an important reason for the price increases are energy prices, import prices for most European countries, not all, but the majority. And that means there is a terms of trade loss. That means there has to be a real income loss. Mm-hmm. And then the question is, who will bear that income loss? We know from the past that when in terms of trade losses happen, that often led to real conflict between labor and capital. And that could be a reason for second round effects. And then just to, as an aside, not for policy now, but in the long term, I think Charles Goodhart and others have talked about the possible inflection points that we might experience due to aging and disinflation, and so in the longer term, inflation may go up. But you asked about financial stability, and I think there should be more focus on that. That, of course, is related to monetary policy, and the hope that macroprudential tools can take care of that completely seems to me a little bit too optimistic. I have looked at some countries that have tried to do that over the last 10 years, including in Asia, like Singapore, but also United Kingdom. And it was very, very difficult to bring financial stability risks under control only through macroprudential tools. And the risks, I think, are obvious. The high valuation of financial assets and housing. We see in all OECD countries this strong increase in housing costs. The OECD has done a very, very broad, comprehensive study on that 2 months ago or so. And I think this poses a risk, not only in the sense that in some countries there might be a bubble and we know what happens when it bursts, but even if it doesn't burst, this becomes a problem for society. If one half of the population is just unable to buy real estate, and that can lead to social conflicts in the long run. So I think it's not sufficient to look at inflation risk. One should also look at financial stability risks.
Thank you very much. I want to take a deeper dive now on the policy implications of both inflation and debt, and ask whether it's really different this time, to paraphrase that book title from Carmen Reinhardt and Ken Rogoff. Is the appropriate policy mix for this next stage of recovery perhaps the opposite of the tight fiscal, loose monetary approach that was adopted after the financial crisis? And I want to get all of you to speak to that, but I'm going to start with Klaus Regling, because you were in fact part of the German negotiating team for the Stability and Growth Pact, including the Maastricht rules that mandated strict debt reduction for countries with debt levels above 60% of GDP. Now you've gone so far as to call that rule, quote, economic nonsense, unquote, in a recent interview. And the ESM is now advocating raising the threshold to 100%, quite a significant difference. So why? What has changed?
Yeah, well, economics and economic circumstances, this is not a natural science. Circumstances change. And, but to be clear, I have not said that the Stability Pact that the rules are nonsense. And we are advocating a reformed system that takes into account the new economic circumstances. But I think in our monetary union, where we have centralized completely monetary policy, exchange rate policy, but keep fiscal policy at a decentralized national level, we do need a good, credible fiscal framework. And it should be simple, transparent, as Jens Weidmann said half an hour ago. And I think the system we have had over the last 25 years needs to be reformed in certain respect. It does not mean that it was wrong when it was created, because at that time, in the mid-90s, it responded to the economic circumstances at the time. And here the key difference is what has happened to the equilibrium, the neutral real interest rate. That is a key aspect. And we had a short discussion a minute ago on how to measure inflation. I think this is another issue where we have to be humble. we cannot observe the equilibrium interest rate directly. It has to be estimated. But there are many, many studies. There's a lot of economic research. The Bank of England has gone back several hundred years, actually, to measure the secular long-term decline in the real equilibrium interest rate. And I think that's what we experience today. There are economic reasons, good economic reasons for that. Aging, increasing wealth inequality, lower productivity gains, all that is contributing to this long-term decline in real equilibrium interest rates. And that means the debt carrying capacity of sovereigns is higher today than what we thought 20 or 30 years ago when the initial Stability Pact was developed based on the Maastricht Treaty. At that time, interest rates were 4 or 5 percentage points higher, and I'm talking about the real interest rates, than they are today. So at that time, this debt target of 60% made a lot of sense. And one can always argue whether it should have been a little bit higher or a bit lower, but it was quite reasonable. If 60% was reasonable 25 years ago, and if the analysis about the real equilibrium interest rate is correct, that it is today 4-5 percentage points lower than 30 years ago, then it makes sense to raise the debt target from that 60%. It could be around 100. Some of the economists at ESM have come up with that number. It could be a bit lower than that, but the key point is that it can be higher. And I think that's in a way very fortunate because there are these huge investment needs that all our economies face to respond to climate change, to make the digital transformation possible. And I think there's a need to have more infrastructure investment anyway. So in a way, we are lucky that we are in this period with a lower equilibrium interest rate, therefore higher debt carrying capacity is feasible without running into debt sustainability problems. It does not mean, to be very clear on that, that money doesn't play any role anymore, and that it doesn't matter how big and how high the debt to GDP ratio is. It doesn't matter, but it can be a bit higher than what we thought 25 years ago. We have to be careful to preserve fiscal space for future crises. We learned, I think, 2 years ago that all of a sudden there can be a big crisis where fiscal space is needed. We experienced that over the last year and a half because of pandemic. We also know there will be additional burden on public budgets coming from aging with higher pension costs and higher health costs, particularly in Europe a bit more than in the US. So be careful. It is not, there's no, it would not be correct to say money doesn't matter anymore and we can have very, very high debt ratios. But my point is it can be a bit higher than what we thought, and that should be incorporated when we think about changing the Stability and Growth Pact, where we also had a few other methodological problems over the last few years and too complex rules.
Just a very quick follow-up question, because you say that this is not natural science, and in fact, there is increasing awareness that the neutral rate is not a standard observable constant, as it were. But is there any risk in this shift in your approach that you are, in fact, doing essentially what Carmen Reinhard warned against, extrapolating on the basis of circumstances that could, in the end, be proved to have been less long-lasting than we think?
Sure, humility is always very important, but I think the evidence that we have from these hundreds of studies that have been done on this topic by all major central banks, by many academics, and by think tanks, indicate that the the driving forces that have brought down these real equilibrium rates over the last few decades, that they continue to be in place. I'm not claiming that I know what happens 30, 50 years from now, but they are in place right now. Aging is becoming actually more prominent in many of our economies. Wealth inequality is becoming more important in all OECD countries, I think. Low productivity gains is something we observe. We all hope that that changes again one day. And if that is the case, then one should factor that in. But at the moment, we don't see that happening. So that's why, despite being careful and humble, I see the driving forces that have brought down the equilibrium interest rate being in place right now. And that's why I think one can build reform, stability and growth back, taking that into account.
Let me just go to Klaus Regling and ask you one last really quick question on debt. Schuldenbremse, the famous German debt brake. Is it definitely time to say that that should be retired as not being part of the right macro mix for this moment?
Well, that's a difficult issue because you get into legal arguments. It's part of the Constitution. There's no majority to change that. From an economic perspective, one should try to find ways around that. And it seems that the coalition agreement that is being negotiated now will try to do that. I don't know the details, but this is likely to happen. I want to make one comment on what Shadi said. Every country is different. I think one area where the euro area countries are quite different is that most member states of the euro area have lengthened the maturity of their public debt over the last few years with an average of 7, 8, or 9 years. So what he described, and also Marcus earlier, that interest rate rises would feed very quickly into public debt service payments, is not the case for euro area countries. It would be a very slow process, so that would help in whatever happens in monetary policy.